Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. In this video on Macro Mondays, it's just going to be a short and sweet one. I'm going to talk about the two structural reasons why gold stocks underperform gold, why they are still underperforming gold. By the way, this video is being recorded on the evening of Monday, December 16, 2024. Let's get to the video. Okay, so in this chart, we have the Barron's Gold Mining Index, which is the best long-term gold stock index, one going back to the 1930s. And I have some data that I attached to it, so my index goes back 100 years or so. So we have that gold stock index divided by gold. Here we have the Barron's Gold Mining Index, which I just spoke of, so nominally. And then we have gold. And one thing I want to point out historically is I see lots of people using these charts that start in 1970. And so they talk about how gold stocks have been bad performers against gold, which is true, but they always start off here at 1970 and they cut off this history when gold stocks were the gold proxy, basically, when we were still at the end of the gold standard. And so gold stocks, again, in the 60s, really outperform. So that's just a pet peeve. I'd love to see when people do this kind of analysis, they start here and then they cut this off. So why don't you start earlier than that? Just one beef I have with that. But anyway, so the two real things I'm talking about is you have the introduction of the GLD ETF. And other ETFs have come, also the SLV ETF. So the GLD ETF, I believe this actually came about in 2004. Yes, I think at the end of 2004, so I have it marked here. So prior to 2004, it's important to understand that if you were a portfolio manager, retail investor, you really couldn't buy gold. Gold wasn't financialized. You had to basically get a futures broker and participate in that market, which, as we know, is extremely risky. And so until the gold and silver ETFs, you really couldn't buy gold or silver. They weren't a factor in financial markets like stocks. So before that, you basically, to get your exposure to precious metals, you had to buy the gold stocks. So that's why, it's one reason why, or one change that has really hurt the gold mining sector, the introduction of those gold ETFs. Because before then, before 2005, in all this history, if you like gold, you want to invest in gold, you basically couldn't. So you had to buy gold stocks. You had to buy Newmont and other stocks. So that has obviously changed to the detriment of gold stocks. So that is a big structural problem that is not changing, obviously. It's a permanent problem. Now, the second thing, which nobody seems to mention, we've been in a secular bear market in precious metals since 2011. We can look here and see the gold stocks against gold ratio. I mean, this thing plummeted right to 2015. The gold price bottomed then, gold prices recovered. So, the ratio has recovered a little bit from that low, but I mean, it really hasn't done anything. Even since the breakout here, it hasn't really done that much. And I'll get to that in the next chart. But, if you're thinking about the gold against the 60-40, that could tell you we're not quite in a new secular bull market yet. So these are the two big reasons. Again, number one, the introduction of the GLD and other gold ETFs, which financialize gold, and at the expense of the mining stocks, because before then you had to buy gold and silver stocks to get exposure to precious metals. So that's been a huge change. And again, the second thing, we've been in a secular bear market in precious metals. So it's important to understand that the introduction of ETFs and specifically gold and silver ETFs for buying gold and silver, that basically has rendered the gold and silver stocks, they're just options now. They trade like options. And, I think I mentioned that in another video. I don't want to go off on a tangent, but yes, they're basically, gold stocks are basically options on gold. And so, as you can imagine, if you're in a secular bear market for gold, that's pretty bad. I mean, that's going to be pretty bad for the companies. So those are the two issues. Now, the secular bear, that will be changing at some point, obviously. I hope at some point soon. We'll get to the next chart. I mean, you know, I have to talk about gold against the 60-40. I mean, I couldn't leave it out of this video, or maybe this video was an excuse for me to put it in. But so this is the same chart as the last one, but I added in gold against the 60-40 portfolio. And so we can see here, you know, this has not made that move up yet. So you could say, well, we're not, I mean, again, with gold breaking out of the 13-year cup and handle, it's hard to say gold is not in a new secular bull. Okay, maybe it is, but for the rest of the sector, rest of the precious metal sector, because there are options on gold, that includes silver, they're more in line with this chart, gold against the 60-40. And again, we can see no breakout yet, so we haven't confirmed a new secular bull. So the secular bear since 2011, based on this, it's been ongoing, hasn't quite ended yet. And we can see, I mean, this is, you know, not that much out of line with the ratio of gold stocks divided by gold. So a lot will change for the gold stocks against gold once we get gold breaking out against the 60-40 portfolio. So when that happens, then we don't have to deal with one of the two reasons, the secular bear hurting the gold stocks. But, you know, even though gold has gone up, you know, gold has not outperformed in real terms. We can see this. And, you know, just to wrap up here, I mean, these are great charts. I love charts like this, you know, thanks to Callum Thomas at Top Down Charts. So this shows all the money in gold ETFs divided by all the money in all ETFs. So it's a great, beautiful sentiment indicator. This shows all the money in the gold stock ETFs against all stock ETFs. I mean, look at how low these things are. I mean, does this, when people say that gold started a bull market or a secular bull started in 2016, I mean, there's no evidence of that. And so finally, the problem that we've had in recent years, you know, with gold going up, but not outperforming in real terms, not outperforming the stock market, when that happens, this is what happens. You know, you get little pops here, but, you know, this is not, you have the pops here, but this has not gone anywhere for gold and gold stocks. And that's because too much money is going into the stock market in conventional investments and not gold and gold stocks. And so when gold breaks out against the 60-40, I mean, until that happens, you're only having a limited pool of capital come into precious metals. And it's just buying gold, and it's buying, you know, the best large juniors, Agnico, Eagle, I mean, stocks like that, royalty companies. And there's no money that's trickling down to silver stocks, juniors, exploration stocks. That stuff is completely dependent on gold breaking out against the 60-40. Because when that happens, that's when you get a real bull market. And after that happens, we're going to see huge rushes come in. So that's it for this video. Again, the Cliff Notes versions, there's two structural reasons. You have the introduction of the ETFs that financialize gold and silver, and because before then people had to buy the mining stocks to get exposure. That's number one. That's not changing. Number two is the secular bear market. That will be changing, I think, at some point in the next 12, maybe 15 months or so. That's it for the video. Thank you so much for tuning in. I hope you all had a great weekend, by the way. Let me know what you think. Leave a comment, and I'll talk to you guys in the next video. Thank you.